Patricia, welcome. This is the second time that we see you on a contexted topic, I must say. But I would like also to tell you that today we have a much broader audience. We have still the countries of the Western Balkans, but we have also two countries now from the EU, because Croatia has entered the EU, but also we have our Polish colleagues from the KNL and KNF who are there. And we also have colleagues from further Eastern Europe, which goes up to Armenia, Georgia, Belarus, and our colleagues from Ukraine. So, Patricia, thank you very much. I think it was very interesting to have this presentation following the one from Shamim, to have a bit of a fast-forward look. Where are we going? To introduce you to the team, Patricia Jackson is the head of financial regulatory advice at E&Y. She leads project on liquidity, stress testing, and bank measures. And you have been a senior official at the Bank of England for many, many years. So you're a regulator by essence first. And then you provide some advice to EY clients, and that would include probably banks, but probably also a regulator in other countries. So thank you for being here. And the floor is yours. Thank you.
Thank you very much. So I'm going to look at Basel III and the effect on business models. But just to pick up with one point that you've just made, all the Basel III, or a lot of the focus of Basel III, is around extra buffers of different kinds, capital, liquidity, and so on, and I'll go into that. But what is really important, I think, for the supervisors to think about is how well governed the banks are. However much capital they've got or liquidity, it comes down to that governance portion. And I was just picking up on the thought that you just illuminated. And I think the areas that the FSB is now coming out with on risk appetite, embedded risk appetite and risk governance become extremely important. And I'll pick up on some areas why that's so important. So just to sort of reiterate the components of Basel III, improved quality of capital, quantity of capital, the leverage ratio, new style buffers so that you have counter-cyclical buffers, the hope of getting higher capital in good times and being able to draw it down in bad times, and then the liquidity requirements. Being phased in over time, and the banks are already phasing them in, but many banks are already trying to more or less meet the standards. If we look at the next slide, all around the shape of these buffers, the potential to have capital higher in good times than bad times, and that's minimum capital. The problem with minimum capital has always been that you can't eat into it. You could never in the past eat into it. If you utilised your minimum capital, you would lose your banking licence. So this is to really put in new buffers that enable people to encourage them to push up the capital in good times and allow them to draw it down, and draw it down with penalties. So it encourages them to rebuild it. So if you're using the capital conservation buffer, if you eat into that layer, you have to rebuild it. And if you don't rebuild it, and while you haven't rebuilt it, there are constraints on paying out earnings. Really important concept. And then there's the buffer that comes in for overheating markets, which the idea is should help to cool the economy down and stop overlending in certain circumstances. And then on the right-hand side, we've got the G-SIFI buffers for the really large institutions that pile on top of these buffers on the left-hand side. I want to just check, how long have I got?
1 hour, but
No, yeah.
to be flexible.
So if we look at the next slide, quite a
Patricia.
bit of Basel... Sorry.
Sorry, just to interrupt. People have paper
Oh,
version
they've got
of
the
your
paper.
slides.
Oh, I'm so sorry.
So-
I thought
no,
it was
but
the
you couldn't
slide
know
4.
that. You couldn't know
Oh,
that.
right.
So it's just slide 4,
Sorry.
just to
Oh,
give
right.
the
Okay. Well,
attention
maybe
on
I
that.
will use. Yes. All right. So we're now on slide 4. So if you look at slide 4, this is getting to the issue of the deductions from capital being phased in over time, and the higher requirements being phased in. So there's a big difference between current core tier 1 ratios and a fully loaded CRD4 basis in Europe. So there's quite a lot still to go. You can look at how the 2013 ratios for the major UK banks will fall if they don't build more capital, which they will do, just to bring in the fully loaded CRD4. So there is quite a bit more to go in terms of bringing it in. If you look at the impacts, we do a survey each year. Ernst & Young does a survey each year with the IIF, and it's available on the EY website and it's available on the IIF website. And it's got quite a lot of data on the impact of Basel III. So one question we asked was, how much more core tier 1 equity would banks have to hold? And you can see that for about 30% of banks, they're looking at between 30 and 50% more capital. And then you've got 10% looking at 50 to 100% more capital, and 20% 100% plus. So depending on the business models, you get these differential effects. People who are heavily into trading, market trading, get higher effects than other firms. People who are holding a lot of securitizations get larger effects. So it's quite a substantial increase in equity capital that we're looking at across the system. If you look at the effect on liquid assets, you get the same effect coming through the liquidity buffers. Very large increases in the liquidity buffers that have to be held. So I'm now looking at page 6, and 30% of the banks in the sample, and this was around 70 global banks across the different countries, are looking at 25 to 50% increases in the liquid assets that they're holding. Now, if you're holding liquid assets, that means you do not have that availability to lend. It's locking up part of the balance sheet, so it affects your capacity to lend, and it affects your rate of return on equity because your returns are lower on those liquid assets. So looking at the percentage of the balance sheet that will be accounted for by liquid assets in page 7, about 20% plus of the balance sheet being held in liquid assets. Looking at the effect on rate of return on equity, you can see with the yellow bars in page 8 the downward sweep in terms of the expectation around ROE. So you don't have very many people, very few now targeting rate of returns in the 20 to 25% range, which got us into the problem in the first place before the crisis. People targeting more around 10 to 15% rate of return on equity. Now, they're going to really struggle to achieve those rates of return. These are target returns, but probably not really deliverable. So another question we asked, and you look at slide 9, what is investor acceptance of lower rate of return on equity? Crucial question. And you can see there isn't investor acceptance of lower ROE. So there's huge pressure from investors driving business model change, reducing cost, search for yield, because they really are not accepting the lower rate of return on equity. And this links to my point about management. In an environment where you're asking for more capital and more liquidity, my goodness, you need as supervisors to look at the strength of the risk management within the firms. You need to get them to embed risk appetite to act as a brake on search for yield. Because if you've got pressure coming in from investors, the counterbalance must be the board, the supervisors and the board, and this embedded risk appetite, which needs to be really quite explicit in terms of how much loss the board is willing to see in extreme environments. That then needs to link through stress testing, because otherwise you will get a drive coming through from the investors which will force again search for yield. And we're already seeing that. To make this square, to make higher capital, higher liquidity, pressure from investors over ROE to square, you've got to have a number of things happening. So if you look at slide 10, margins on lending have to rise because they're not high enough to cover the return on capital that people need to achieve. They have to reduce costs, and there's cost cutting going on across the industry. Now, as regulators, you need to look at that as well. Which bits are being cut? Are they cutting key functions? Are they paring back on some of the protections around their systems, the testing in the systems? Are they delaying systems improvement? Are they cutting the risk function? So where they're cutting costs becomes important. Leverage has to fall, no doubt about it. Unprofitable businesses have to be exited. These business models are not profitable. They've got to come out of the key unprofitable bits. ROE has to fall, but how do you convince the investors that that's okay? So this gets into the quality of the disclosures you were just talking about, but making them really comprehensible. Lots of data does not help. It needs to be leaner, more pointed, all the rest of it. And then they've got to improve capital efficiency. They cannot waste capital in this environment. So you look at the wide range of regulatory drivers that are impacting decisions on slide, oh, it's not numbered, it's the one with the Sputniks. So we have a slide that looks at the range of regulatory drivers. And of course, beyond Basel III, we're talking about a range of impacts affecting the profitability of the banking sector. So you've got host country governance models which are being enhanced. You've got recovery and resolution. You've got OTC reforms. You've got global booking centre pushback for the major banks. You've got country-level capital and liquidity, the balkanisation of banking, so higher capital and liquidity required in subsidiaries. You've got the banking reforms in the EU. We're going through AQR at the moment. You've got activity-based reforms, Vickers, Volcker, Liikanen, ring-fencing different activities. You've got similar things happening around the holding company structures in America and so on, FTT. So all of this together is impacting viability and business models, and all of it is pushing down earnings on the banks. So what effect is this having on lending? So if we look at page 13, what you've got here is some results from the 2014 survey, which we are currently compiling. So this is not, won't be published till the autumn, but it's got some quite interesting results. So more than 70% of banks in the sample, and this is a huge global sample, are evaluating portfolios. You've got almost 40% exiting lines of business, so coming out of whole categories of business that they were doing before. You've got almost 40% coming out of more complex instruments. You have around 15% coming out of whole geographies, so they're exiting whole countries and leaving those. You've got 20% streamlining their legal entity structures, and they have to do this to rationalise capital. When you have balkanisation with countries requiring more pots of capital, you've got to streamline. It's too painful, too costly. So, huge range of activities. So what is the other side of this coin? So you've got a huge coin which is all about changing business models. The other side of it is shadow banking. So at the same time, we have a huge shift of activity into shadow banking. And I'll come on to that a bit later. We've got banks also starting to change pricing. They're changing pricing for liquidity and credit lines, and this looks at the results around that. So a number of different changes being brought in to cover some of the higher capital and liquidity costs. So it's already moving into charging, but they cannot change charging sufficiently to cover the full effects, and that's why it's driving into shadow banking. So if we look at the slide on loan pricing, they're still not fully sure of the full effects on loan pricing. So we're seeing people wrestling with how much can they change loan pricing and still retain the business. So this is going to adjust over time. So one of the issues is how much of the change we're seeing is cyclical and how much is structural. So if you look at the drivers of regulatory reform, decline in cross-border claims, we're seeing a huge fall in cross-border claims. And this is partly because of the retreat of banks to their heartlands. If you're under capital and liquidity and ROE pressure, you will retreat to your heartlands. Your heartlands really being your home country and your core countries around that. So I think this is not just cyclical, I think this is structural. Indeed, at this point in the cycle, with economies beginning to pick up, you would expect to see cross-border claims rising. So I think this is structural, and I think it's to do with Basel III. If we look at page 17, what effect is the deleveraging that we're seeing in the banking industry having on particular areas of business? And I've taken 3 examples. There are 3 classes of activity which have now moved outside the banking sector. Banks do not do project finance, by and large projects, that's moved to shadow banking. They don't do infrastructure lending, they don't do energy finance. I was asked by SWERF, which is a big research institute across Europe, sponsored by some of the central banks, to write a chapter for their 50-year anniversary book. And it's worth looking at this book, it's on their website. And I was asked to write the chapter on 50 years of shadow banking. And I was shocked by the huge variety of mechanisms that are now growing up to deal with shadow banking and the sheer volume of it. Now, if you look at slide 18, I've set out some of these structures, and some of them are very complex. It's not securitization, but it's quasi-securitization. So you've got tranched funds, not being turned into securities, but where the returns are tranched, and you have different investors taking those different tranched returns. You have a variety of structures involving PE houses and leverage to get funding into SMEs, to get it into project finance. You've got insurance companies going into core lending. So this isn't insurance of credit, this is core lending. So you've got investment fund vehicles being set up to direct funds into a variety of lending. We're starting to see funds of funds sitting above these different structures. And the chapter I wrote goes into a whole variety of these different structures. If you look at the effect of the leverage ratio, the world's regulators have got to be very careful what happens with the leverage ratio. If it's a backstop to risk-based requirements, fine. If it becomes the front stop, you will see even more activity moving into shadow banking. If you look at this chart on page 19, banks' balance sheets have traditionally concertinaed over the cycle. This has happened in almost every cycle. As the economies pick up, the balance sheets grow and leverage grows. And this happened obviously in a more extreme way in the run-up to the crisis, but it is normal for this concertinaing to happen. It didn't happen in America. It didn't happen in America because the leverage ratio was biting. And so what actually happened was the leverage was occurring in shadow banking in structured products. So if you stop the concertinaing of the balance sheets, it happens elsewhere. It happens in shadow banking. So you look at the flat path of the US commercial banks' balance sheets on the left-hand side. That's because the leverage was in shadow banking. It was in these structured products, and that's not picked up there. So it's really important that the leverage ratio is a backstop, not a front stop. And in America, it was a front stop. That was the thing that bit, not Basel I, although the Basel I itself is very like a leverage ratio. So does it matter? Does it matter if activity shifts into shadow banking? And this is a really important global issue. This is something the World Bank, the IMF, the BIS really needs to be wrestling with. Now, some people are defining shadow banking very narrowly. They're saying it's money market mutuals. It's all around maturity transformation. I don't see it like that. I think that's one aspect. I think lending is a core aspect of shadow banking. If you shift lending out of the banking system and into the insurance companies, that, to my mind, is as important to consider as maturity transformation. So one issue is, and we're talking about, I underline, enormous volumes here of activity shifting. So we're talking about shadow banking now being larger than shadow banking pre-crisis, when it was fueled by the 2 trillion securitization market. So it's now again larger than it was then. Does it matter? Well, they may not be long-term participants. This is not their core activity. An insurer it's not their core activity. They're searching for yield. So one issue is, if yield picks up, do they start elsewhere? Do they exit or slow down their production of lending fueling the economy? In which case you've stopped the banks concertinaing their balance sheets, and the escape valve doesn't work, because the shadow banks say, actually, I can get return elsewhere, and I'm not going to do core lending. So that's one question. Another question is, what happens if default rates in the lending that they have done rise above the levels they've priced in? Do they then retreat? Do you then find also they're not providing that escape route? So you've stopped the concertinaing of the balance sheets in the banks, and they retreat because the shadow banks retreat because they've burnt their fingers, basically. Now, why is this an issue? Well, it's an issue because this is not their core activity. So lending, doing SME lending, is not their core activity. So they don't necessarily have the models and structures that the banks would have in place. And for this chapter for SWRF, I analysed how different organisations look at credit. So if we look at slide 21, banks will do a core credit analysis, right? They have scorecards for customers, they have models, they rely a bit on diversification, but that's not the core bit. The core bit is the credit assessment. In some areas like mortgages, yes, of course they're relying on the security, but it doesn't override the credit assessment. If you look at structured products, so securitized paper, it's very dependent on the credit enhancement structure in the vehicles, above the vehicles, the waterfall, and diversification in pools. So it's not around credit assessment, it's around diversification and enhancement. If you look at institutional investors, they are very heavily reliant on security. That's why they do project finance, infrastructure finance. They look much less at core credit quality. It's around security. And that is actually fairly dangerous as a path, because we know what can happen to security values in certain downturns. If you look at things like peer-to-peer lending, which is growing, so peer-to-peer lending, you get lots of individual investors who put a small amount of money through a platform into a range of different borrowers. So I might say I want to invest £1,000, and I will invest it £100 in a whole variety of different little shops. I'm relying on diversification. I haven't got more than £100 exposed to any one shop, not the credit assessment. But there again, you can get downturns that could hit a whole variety of those SME lenders. So it's a different way of lending, and you could see default rates rising quite sharply in the shadow banks. The other area that is hit quite hard by Basel III, where you're getting real effects, is the trading books. Now, if we go on to the trading book section and we look at slide 23, the overall effects on the trading business models are very, very big. So if you look at the percentage increase in capital requirements for trading books under Basel III, this is 2.5 and 3, 38% of banks in the sample saw increases of 100 to 200%. Now, part of that is the CVA charges, and people have modified some of the CVA. They're trying to get these down. They've got to use capital efficiency to get some of these charges down, but they're still very, very large increases. The percentage increase in capital charges on OTC derivatives is huge in its own right. Now, this is leading to the exiting from certain types of activity. So paralleling what is happening with lending, we no longer have a long-term swap market. We no longer have markets in some of the more complex derivatives. So this is changing the scope and liquidity of some of the hedging markets. So that is quite fundamental. If you look at Vickers, Dodd-Frank and Liikanen, page 24, this too will drive cost and will drive exiting from market-making activity. So some of the liquidity in the core markets is going to come down. So basically, looking at slide 25, Basel III is changing the shape of markets. So banks are exiting capital-intensive position taking. It's too expensive. It's too costly. They're coming out of things. The example is long-dated swaps, but it's other types of instrument as well. So, and the liquidity charges that have to come in to a degree in the trading book reviews, because VAR models don't really work for liquid instruments unless you have some sort of liquidity charge, are going to drive illiquid markets more illiquid. And so we will see charging changing, so spreads changing in traded markets, and we will see liquidity changing in traded markets, and this is already happening. So is evidence for greater concentration of fixed income and currency trading. And it's being concentrated in the top 5 investment banks. So what we're seeing is activity actually moving into the US investment banks. There are a few banks outside that pool, but the effect has been to move activity more into US investment banks. So I've covered the effects on liquidity and the effects on the traded markets. And these effects have yet to fully play out. We will see it playing out over time. We probably will not know for, I think, probably 5, 6, 7, maybe 10 years what the effect is going to be. This underlines one point which I didn't make when we were talking about the differential capital that comes out for different firms under the different requirements and the effect of leverage ratios and so on. A lot of the thinking behind the higher capital charges was based on Modigliani and Miller. Now, Modigliani and Miller is a very old finance paper, and at the centre of it, I think it goes back to the 50s, at the centre of it has an easy concept. The concept is, if you double the capital in an organisation, other things being equal, you have halved the risk to the counterparties. And therefore, the costs of equity, the cost of funding will fall commensurately. So double capital, the risk has gone down because there's a bigger capital buffer to absorb any risk. So any exposures to that organisation are lower risk and should have a lower charge. So the thinking was, well, it didn't matter if you ended up with differential effects across different banks, because banks with more capital would benefit from lower costs of equity and funding, and it didn't matter how high you push the capital up. Now, the problem with that, which none of the papers address really, is this is a long-term concept. And the question is, how long does it take you to get there, and what are the adjustment costs? Helvig has written a paper basically based around Modigliani Miller, but he does not discuss the adjustment cost. Now, the adjustment period could be 30 years, because how many cycles do you need to convince the equity investors, for example, that if there's more capital, people aren't gearing up on the risk. They're not searching for yield. So, okay, capital's gone up, but risk has also gone up because people are searching for yield. And this is why you're getting this pressure on ROE. The investors are not convinced that the system is necessarily safer, and it could take decades to convince them, and that's a really important point. And that's why some of this will take time to play out. So let's turn to the final question, which is, will Basel III make bank lending more stable? So this is one of the concepts behind it. Does it stabilise the pressure for over-lending in boom periods? And this is where these different counter-cyclical buffers come in. So the counter-cyclical buffer is a really positive development. It has to be. Having capital that you can utilise, you can draw down, you can eat into, I think is really important. So getting people to build capital in good times when they take the risk and eat into it in bad times when they need to put up the provisions is a very important concept. But if it's going to work, authorities have got to convince the markets that 4.5% of capital is enough. If there is rhetoric from different central banks and regulators that actually banks need 15% or 20%, you will never convince the markets that it's okay for banks to eat into the countercyclical buffer in bad times. This is a really important point. And the parallel here for all the central bankers here is monetary policy. We know with monetary policy, loads of papers on it, that you reduce to the minimum the noise to signal ratio. You don't create confusion around what is expected. You don't say, I've got an inflation target of 3%, but actually, I think it ought to be 5, or maybe it ought to be 2, or maybe it should be 10. Because you create enormous confusion and expectations. Now, what has happened in bank capital is that there have been papers being shooting around the ether, talking about 15, talking about 20. Now, if you do that, the noise to signal ratio gets huge, and institutional investors cannot interpret where is this going in the future. So they discount future earnings of the banking system hugely, and you create an enormous amount of confusion. You also create a view in the markets that 4.5 is definitely not enough. Now, the Bank of England and the EBA have tried to tackle this, in my view, in the latest stress tests. So the latest stress tests for the European community have been announced, and the PRA in London is doing some stress tests, the EBA is doing stress tests. And the EBA has said that they will react if banks' capital falls below 5.5. So they're saying, actually, the concept is that people will dip into capital, and we accept that 5.5 is enough. The Bank of England has rightly, I think, gone further and said, we will react if people go down to 4.5. Because you look at the concept of those buffers that we looked at right at the beginning, the concept is that the floor is 4.5. You look at slide 3, the concept is the floor is 4.5. And you allow people to dip into the conservation buffer in bad times down to 4.5. So if you want people to do this, you've got to create the right rhetoric around it. So that's one big question. And then another question is, what is the magnitude of the effect? So let's look back at slide 3 again. This looks like quite a big buffer that you're building up in good times to draw down in bad times. But how big is it really? So let's look at this. Now, for many of the world's largest banks, they're on the IRB, the Basel II IRB. This is the internal ratings-based approach under Basel II. And the issue here is for capital conservation to work, probability of default has got to be stabilized. Now, in the Basel II wording, there is lots of wording around probability of default for borrowers being through the cycle concept. But many supervisors have implemented it as point in time. The reason why some people have done that is if you say to a bank, I want you to model probability of default point in time, you can then compare what comes out of their model with current arrears rates. And that gives you a sense of security. The trouble is it's not telling you very much about the risk. And indeed, those point-in-time models are themselves driven by the arrears rates. So you're comparing an input with your comparator. So of course it looks okay. If you look at the diagram on page 29, and there's more data on this in the paper I quote at the bottom, for a mortgage book, the probability of default point in time can go up 5 times boom to recession. 5 times. Now that's going to massively outweigh any counter-cyclical buffer that you've got. So the key basis to capital conservation has to be to stabilize the PDs. Now, you'll never completely stabilise them, but a through-the-cycle PD might say, well, actually, I think on this class of business, I'm going to lose about 1% through the whole cycle on that particular loan, rather than 0.01 in the boom and 2% in the recession, or 1.5% in the recession. So, but you'll get a bit of variability, but nowhere near as much variability as this. And the problem with these point-in-time PDs is they massively damage the signal, the quality of signal that goes to the board and senior management in a boom. So if you look at the blue line relative to the red line here, the blue line is the riskier mortgage. The blue line, the blue line is the safer mortgage. The blue line is the traditional high-quality mortgage, pretty high-quality mortgage. The red line is the risky mortgage. Now, in the boom, there is a inversion of those two risks, because a buy-to-let book, point in time, looks much safer than a traditional mortgage. You have fewer arrears rates, and then it reverses when the risk crystallizes in bad times. Not only that, the differential between the good and bad mortgage looks hardly anything at all. Whereas you can see from the centre, when you've got the recession, the differential is very big. So it looks like you're not actually adding risk, you're actually improving the quality of the book because of the point in time. And that will damage your management of your risks in the good times. So in theory, the counter-cyclical buffer is a great idea. If you can do two things, you can make it work. So if you can get the rhetoric right around 4.5 being enough for the banking system, as authorities, that will allow the markets to let people eat into it in bad times. And if you can stabilise the PDs, which you can do by getting people to model through the cycle, you won't then be able to compare it with current arrears rates, but that's not the point. The point is, how much could they lose over the longer term? And you need to use different bits of data and different indicators. So it's doable. Now, what about the bringing in the macro buffers? So if you look at the macro buffers, the idea here is the Bank of England could say the housing market in the UK is now overheating. We're going to bring in an extra 2.5 percentage points when anyone lends of capital, when anyone lends from wherever in the world into the UK housing market, as an example. The problem is with that is, when markets are really overheating, house prices could be rising by 15 to 20% per annum. Am I running out of time? No.
No, absolutely, we're fine.
Okay. So if house prices are rising by 15 to 20% per annum, does 2.5 percentage points of capital make an iota of difference? And I think very little. So this really means that you've got to think about the whole level of interest rates. You can't just do it through capital. You could do it through LTV ratios for the mortgage markets and commercial property. You could say, okay, so 2.5 percentage points more of capital, and you can't have LTVs of more than 90%. That's the loan-to-value ratio, or 85%, or whatever. And then maybe do something on interest rates as well. But the capital alone is not going to be enough. If we look at this issue of the leverage ratio containing growth on balance sheets, so we look at page 33, is this going to affect growth in good times when you want to see the economies picking up? And the issue here is it has this different effect on different banks. So if you take a bank B, which is a low-quality bank, it's lending to low-quality assets, 3%, which is the leverage ratio, is a low amount of capital. It's going to be substantially lower than that bank's risk-based capital. So it doesn't really bite. You look at Bank A, which is a high-quality bank, it's got high-quality mortgages, the leverage ratio doesn't recognize security or risk. 3% is very high relative to risk. So it's going to bind for the good bank, and it's not going to bind for the bad bank. And we can take here an example of the Coventry Building Society, which basically has high-quality mortgage loans. Its core Tier 1 ratio on a risk-based basis is 22%. Its leverage ratio is 3.2%, because none of the high-quality security is captured, nor the high quality of the borrowers. So it's going to have a differential biting effect on the higher quality banks. Now, this could push banks in some countries to push their balance sheets down the higher risk spectrum. And this is exactly what happened in America. American banks, where the leverage ratio has bitten for years, they do not hold mortgages on their books. They don't hold credit cards on their books. They don't hold student loans, auto loans. There's a whole class of low-risk activity which has been moved off. The whole composition of those books is higher risk than the books in Europe. So, and that has been driven by the leverage ratio. And then we get into this issue of Modigliani-Miller. It's really crucially important in this adjustment phase to Modigliani-Miller how much capital a bank is being asked to hold. Okay, and then I've provided some references in case you want to look into this any further. Okay, so quick canter through the topic.
Patricia, thank you very much. I think it gives us a lot of insight, not only on how things could unfold in the future, but also the why things were built that way. I think that is very, very interesting. There's so many takeaways that I can't get through them all. But if I get one for our regulators is probably the growing complexity of different financial engineering to get into more shadow banking, so less regulated areas, which is going to be a problem. And obviously that will touch not only the Western European countries, but probably too the Eastern European one, and they are not well attuned yet with this complex financial engineering systems. So I would like to thank you very much. I would like to do a quick turnaround to our participants to see whether there are some questions. I will go once through the list. We have 15 sites. I will allow one question for each site. I'm very sorry we have so many sites that it's very difficult. This event is more for communication. It's not about, when we have 20 sites, it's more about communicating out some information rather than being very interactive. It's to sharing some knowledge, but I would still want to give our participants a little opportunity to provide a question if they want to. Thank you. So I'll start by Albania.
Hi, thank you. We don't have any questions. We'd like to thank the lecturers for their presentation as well. Thank you.
Thank you very much, Albania. Armenia, is there any question? Armenia, any questions?
Yes, there are no questions. Thank you.
Thank you very much. I would go to Belarus. Is there any question?
Yes, there is a question. We would like to ask why into CET1 capital do you include operational revenue and profit, while it is not like stable, rather than use reserve fund for that.
You mean in the calculation? Well, once it's been audited, once the profits have been audited, and they are regarded as in the bank, as it were, secure, then they immediately go into capital. And what you're trying to do is to get people to retain earnings to bolster those capital elements. So retained earnings are a very important way that banks have of building up their capital buffers.
Thank you very much. Bosnia, any question in Sarajevo?
We don't have question.
Thank you very much for participating. Georgia, would you have any question for our speakers? Tbilisi, Georgia?
Hello. Can you hear us?
Yes, absolutely, Nino. Is that Nino? No.
Can you hear us?
Yes, absolutely, we
hear
can
us?
hear you.
Oh, great. Thank you for your presentation, and we do not have any questions.
Okay.
Thank you very much. I would go to Kosovo. Any question from Kosovo?
Thank you very much. We don't have questions.
Okay.
Okay. We'll go to Macedonia, Skopje. Any question?
No. Thank you for the presentation and for the thorough and effective presenters that will help us implementing Basel III in the future in our regulation.
Thank you.
Thank you very much. Montenegro, Podgorica.
Hello, we don't have any questions. Thank you for the presentations.
Thank you. Moldova, Chisinau.
Hello, we don't have any questions, but we would like to thank you for sharing your experience with us. And we are also waiting some similar webinars on CRD4.
Okay, thank you very much for your participation.
Thanks.
Poland, is there any question in Poland?
Hello, thank you. Yes, I do have one question to Patricia. I was really, while hearing your what you had to say about the banking and the own funds, I was thinking of the rhetoric that you underlined, that the supervisors should actually stick to the rhetoric that the 4.5% of own funds in the CET1 is enough. And then while looking on your example on the Coventry Building Society, I had a slight, let's say, it was really uneasy for me to actually argue that for such banks or such companies, it would be enough to stick to 4.5. What would you recommend in actually arguing for those high quality banks?
Yes, so the issue with the Coventry Building Society is that it gets hammered under the leverage ratio. The leverage ratio, yes. Because it's not. So for smaller banks, you might say, actually, we want a floor of, we regard a satisfactory floor as not 4.5, but I don't know, 5.5 or 6 or something, but I'm not pushing it up into the 10, 15, 20, because the trouble is that you then make it very difficult for markets to accept that capital can be eaten into. So I think there is rhetoric that you can use around, in good times we want to see higher buffers so that they can be eaten into down to a floor of whatever, 5.5, 4.5, whatever seems reasonable, which is a reasonable level in the recession. But it's getting that language right that I think is really important. And I do think these papers shooting out of different authorities globally, talking about 15 and 20 and goodness, just confused. So I think having a very clear global rhetoric, which is around, well, in good times, we want to see more capital so that it's there to absorb losses. And in bad times, you know, it will be okay for banks to go down to 4.5, 5.5, whatever is reasonable. But I think it's having a consistent story around it.
Okay, thank you very much.
Thank you. I would like to ask Serbia if there is any question.
Thank you very much. We don't hear any questions.
Thank you. And last but not least, if Ukraine is connected still, is there any question? Sorry. No question for Ukraine. I would like to thank everybody for participating. I would like to thank the presenter for quality presentation. Really, this was very, very interesting for, I think, us all. We will, in the coming days, send a link to this little event so that you can share it with some of your colleagues. I think this could be important, given the quality of the presentation and the quality of the presenters. Thanks again to Patricia. Patricia, I know you have a very busy agenda. You make time for around 17 people in 14 countries. This is very nice of you. It took you probably some time to prepare also this presentation. Shamim, many thanks for organizing this on your side. And I would like also to acknowledge the participation of the WorldBank team, which would include Cornelia Zasha, that you don't see here, but she's actually in the room, and Joanna Lincoln. She's also in the room with me, and they have contributed to get the participants and organize all of what is happening here. And we also have Juri Sekiguchi, who has been helping to coordinate the logistics of that event. Thank you very much again. I remind you that we have this IFRS workshop on June 4 to 6. I noted that we don't still have any participants from Belarus, and we have participants of Belarus to that seminar. So Belarus, if you want to come, you're most than welcome. Thank you again, and have a very good day. Goodbye.
Thank you.
Thank you.
Bye.